If you want to get rich, you start a business. If you want to get wealthy, you buy one. But if you want God tier, buy a super yacht just to park your other super yacht money. You don't just buy businesses, you raid them. Welcome to the world of private equity. It's an industry managing over $13 trillion globally. That's bigger than the GDP of Germany and Japan combined. They brand themselves as capital allocators who unlock value. I call them corporate shops. Today, we're looking at the private equity playbook, the specific three-step mechanism used to buy beloved companies, strip them for parts, and walk away billionaires while the carcass rots in bankruptcy court. It's legal, it's brilliant, and it's absolutely ruthless. Let's learn how to do it. Okay, future billionaire, you want to buy a company. Let's say Jeffrey's Toy Box, price tag $6 billion. Problem, you only have $1 billion. Normal people would say you can't afford it. Private equity says, hold my Dom Perignon. Enter the LBO, the leveraged buyout. It is the nuclear weapon of high finance. You put down 10% or 20% of the cash. You borrow the rest from big banks. You buy the company. Now here is the magic trick that makes this entire industry exist. Who do you think is responsible for paying back that massive loan? You? No. You transferred the debt onto the company you just bought. Imagine buying a house and then telling the house it has to get a second job to pay its own mortgage. That is an LBO. Suddenly, Jeffrey's Toy Box isn't just selling action figures to make a profit, it's selling action figures to survive drowning in interest payments. You own the company now, it's drowning in debt. Time to unlock value. This is corporate speak for firing people and selling things. You need cash flow to pay that massive new debt. So you cut costs. R&D? Gone. Employee benefits? Slashed. That weird guy in accounting who actually knows how things work? Fired. But the real pros don't just cut costs. They feast. Let me introduce you to the nastiest move in finance, the dividend recap. The company is already struggling with debt? Perfect. Force it to borrow more money and immediately pay that borrowed money to you as a special dividend. You have now made back your initial investment before you've even improved the company. You are playing with house money. If the company dies now, who cares? You already got paid. Don't believe me? Let's look at the body. Toys R Us. In 2005, three firms, KKR, Bain Capital, and Vornado, bought it for $6.6 billion. They put down about $1.3 billion in cash and loaded the company with $5.3 billion in debt. Before the buyout, Toys R Us had $2.2 billion in cash. Afterward, they were spending over $400 million a year just on interest payments. While Amazon was building the future of e-commerce, Toys R Us couldn't afford to fix their ugly stores or build a decent website, because every spare dollar went to feeding the debt monster. But don't worry, the PE firms did okay. Before Toys R Us went bankrupt in 2017, wiping out 30,000 jobs, the firms extracted over $470 million in fees and interest. They ate the meal and left 30,000 employees with the check. Step 3 is the flip. Take whatever is left of the company, pretty it up with some adjusted EBITDA accounting magic, and sell it to the public via an IPO or to another sucker. Sometimes this actually works. Companies do get leaner, meaner, and more profitable. But often, private equity isn't about building better businesses. It's about financial engineering designed to extract maximum cash in minimum time. It's a heads I win, tails you lose system. And until the rules change, the looting will continue. Thanks for watching. Subscribe so I can afford my own leveraged buyout of a small pizza chain.